Welcome to Massive Passive Cash Flow, the podcast that guides professionals to financial prosperity. Join our community and let's start building your wealth. Here's your host, Gary Wilson.
Welcome back to the Massive Passive Cash Flow podcast. I'm Gary Wilson, your host. I'm glad you're back listening to the show. We got a great guest today, Frank Rohde, and he's got an awesome story. I want you to really pay attention. So if you're driving, just listen. You can get home later and get the show notes and get all the details there. If you're not driving, definitely take notes and write down questions, because we have a way of helping you get in touch with our guests and me also. If you ever want to reach out to me, I'll help you do that also. So first off, Frank, thank you so much for joining us, man. I really appreciate you taking your time to share your story and what your current project is,
Thanks, Gary. Thanks for having me. Really appreciate it.
You're very welcome. If you wouldn't mind, you and I have spoken, and I've read your bio. I just think it's fascinating. Would you mind sharing a little bit about your background and take us? How did you go from where you started to where you are now? If you can tell that story, that would be really awesome.
Sure. Yeah, I was born in Germany and grew up there, and not we talked earlier, not as an army brat, right, in the best sense of the word, but as a German. And as when I was 16, my parents said, do you want to go to America as an exchange student? And I said, well, that sounds like a great idea. Sign me up. So I spent a year in California, in Northern California. And, most people think San Francisco is Northern California. That's actually the middle. There's another whole part up way north that's really empty. So I ended up spending a year on an Indian reservation, the Hoopa Indian Reservation. Went to high school there, got my high school degree. Learned things that you don't learn in German high schools. Like I took, wood shop and auto shop, and learned how to work on cars and all that. Anyway, so that kind of started my affinity and my passion for the U.S. And when I went back to Germany, I said, okay, I'm going to come back here. So finished high school, joined the Army, which was mandatory at the time, and then went back to the U.S. to Philadelphia, Penn, and did the Wharton undergrad program as a student. With the intent of staying in the U.S., and that worked out. I ended up getting a job with Oliver Wyman, a consulting firm that brought me back to San Francisco, which was the original intent. Loved that city and said, okay, I'm going to work here. And so I spent a couple of years in financial services, working for Bank of America and Wells Fargo and Allianz Insurance, banking. So that got me started in the financial services sector, really, from day one. Then I went off and in the first internet boom with a couple of colleagues started an online insurance company called eCoverage. And that, grew very rapidly and then cratered like a lot of other companies. So I learned my lessons there on how not to run out of money, most importantly. From there, I went and joined FICO, the company that makes the credit score, and spent 4 years there. Ultimately ended up running a business called Enterprise Decision Management, which is the rules engines and scoring algorithms focused on credit underwriting and optimization of consumer offers. And so that was my first exposure really to how to use data and analytics to make consumer-based decisions around consumer products, credit cards, loans, deposits, mortgages, etc. So that got me into that space, and then I was recruited early on by the two founders into a company called Nomis, which is a software company. The two founders had put it together. I joined as head of sales and marketing, and then very quickly took over as CEO. This was in 2008, 2009, right before the credit crisis. And then I grew that business from the start really to about 25 million in revenue. And Nomis was still is focused on pricing for financial services, in particular mortgage pricing, right? So if you think about kind of the mortgage that's being sold to the consumer in the US and Canada, the UK, Australia, we work globally. It's a fairly complex math problem to figure out what exactly should the fees, terms, conditions, the interest rate be for someone who borrows $800,000 to buy a condo in Miami, with this FICO score and this income, et cetera, and so forth. And so I spent almost 15 years in the bowels of mortgage math, really getting deep into this, working with most of the large lenders in the US and North America. And so as part of that, I started seeing this problem that we're now tackling, right? And so this kind of completes the arc in the story to Ownify. But one of the things I kept seeing in the data is just the struggle that first-time buyers have in the market, right? Getting into their starter home. So had a number of conversations with our customers who are the big lenders and mortgage lenders. And at the end of the day, the mortgage industry is very rigid in the sense that they sell government-structured and government-sponsored products, which are great products, right? And the government taking on interest rate risk is unique in the US. We don't have that anywhere else. But it also means that innovation is very hard around product structure in particular. So eventually I sold Nomis and then started a company called Ownify, which is what I'm now running, specifically with the mission of building a new path for first-time home buyers, right? And when we were chatting earlier, you made an interesting point. You used the phrase, adversity creates opportunity, right? And so if you think about what's the opportunity here, the problem we're looking to solve and we're solving is one that I think everyone understands anecdotally, which is first-time buyers are having a tough time buying their first home.
Yeah.
And that adversity creates opportunity for us, right? There are a lot of folks out there who are getting older and older, haven't been able to buy their home. And when you dig in and try to kind of understand why that is, right, there's a number of underlying reasons that we're looking to solve. But I don't want to, let me pause there because that was a long monologue and you asked me for the intro. But so that's the arc in the story that kind of got me here.
Well, I love your history because you're definitely an entrepreneur, but you've also got some experiences as an employee working for other corporations. And I think it's important to have that. I know in my background, I started off working for other, the government and then banking. And so you learn structure and management skills and, strategies like, analyzing data, measuring, metrics, you set your goals. Well, how do you know if you're accomplishing your goals? Well, you have to have metrics and you have to inspect what you expect, So all of those skills I learned, I brought into the world of entrepreneurship where I started building businesses. And have you found the same thing? Like you, even though you probably would prefer naturally to be an entrepreneur, I'm guessing you probably gained something from your years as an employee, learning from other companies and how they run their businesses, and you can apply that. I mean, I think it's just part of the learning curve. Has that been your experience also?
Yeah, I think there's a really interesting, every business has, or as an entrepreneur, you have tools at your disposal, right? And so management metrics, right? Really being focused on goals and OKR, objective key results process. That is super important, and we use it today. But one of the things I learned as an entrepreneur is you also need to be really careful about what you bring to the table when, right? And early on, it's all about, rapid experimentation, rapid test and learn, getting all the failures under your belt quickly so that you can get to what works, right? And then start measuring that and building more of a business process and more of a repeatable motion, right, around product market fit and go to market and sales and service and all that. So what I'm really fascinated by is the transition of how do you go from an idea to putting it on paper to testing validation to then getting the first 2-3 people a little bit of money, right? To the point where now, okay, you have a couple of million in revenue, and it becomes much more important to focus on the metrics and how you grow and all that, right? And then and one of the interesting experiences I had along the way, right, working for FICO as a big company or with Oliver Wyman for big companies is just understanding how big corporations work. And then somewhere along the way, working for private equity, right, when I had sold Nomis to a private equity firm, that was very insightful learning as well. The focus on expenses, right, and profitability, and how you drive EBITDA and all that, right, ultimately for your investors.
Did you know that you can participate in class every Monday? We call it Monday Night Live, 7 p.m. Eastern, with me and dozens of other investor agents from around the country, in fact, the world. Every Monday, totally free. No selling, no recruiting, just straight up education on anything and everything in real estate. And we have a lot of good guests coming on once or twice a month, bringing in expertise on subjects like how to buy a house with crypto. Okay. How about them apples? What about AI? How's AI affecting our business? How about the metaverse? blockchain processing. We're already using it in title work. So come on to Monday Night Live, be ready to take notes and ask questions because it's live and engaging, and you get to participate by asking questions and meeting others. So we'll see you there. Go to realestatewithgarywilson.com, click on the resource tab, drop down, and you'll see Monday Night Live. And in there, you can see one of the most recent classes. But more importantly, you can register for class as many as you want going up to like the end of the year, I believe. So in any case, do that. We'll see you on Monday Night Live. Look forward to meeting you in person. Take care. Yeah. Okay. Now, so take us into the current business venture, Ownify. The problem, obviously, I mean, there's several things going on in the real estate industry right now. We've had several years of a very rapid increase in prices and properties during the pandemic years. And by the way, that was, if you go back to the beginning, you look at the last recession, it was a long, deep recession. It was very painful for a lot of people. But the recoveries are usually longer than recessions. But the recovery has been an astounding, long-running recovery. And for several years, it was really nice. I mean, there were, I would say historically normal price increases, rates were low, the economy was improving in a very solid, healthy way. Then all of a sudden we get the pandemic years and everything's just kind of thrown for a loop. We've got lots of people out of work, but everybody was getting money from the government. And everybody thought, well, this is going to crash real estate, but it didn't. I mean, it created a lot of demand, and the demand exceeded supply, so you have massive price increases. Then we have inflation because we printed too much money, and we were overpaying for properties, and everything it's just so many related impacts. When you have increased fuel costs, it means transportation costs increase. So it costs more to ship all of those supplies for building houses, and not to mention groceries and so forth. Then you have interest rate rises, and here we are, and we've also got a shortage of housing in the country. Some of it is just due to the fact that we just haven't kept up with the demand, but there's also been a large increase in the influx of immigration in the last several years. And there's always debate about is it good or bad. I think it's both. I mean, we're a nation of immigrants. You want to have immigrants coming in, but it does create more demand on housing. So now here we are, and the first-time home buyer is one of the business, this what I call the sectors, the consumer sectors, that is probably being impacted more than a lot of others. And I guess that's where this comes into play. So tell us a little bit about Ownify. What is it? How does it work? And if you have any examples, like a case study of a avatar for a typical client that you serve, that would be awesome if you don't mind.
Yeah, sure. So Gary, you hit the nail on the head, right? One of the fundamental structural problems we have in the US is that we have an undersupply of housing, in particular single family homes, right? And there's an interesting economist that I like to follow called Kevin Erdman. He's built this model that basically points to 2/3 of home price movements are supply and demand driven, and about 1/3 are financing cost driven, right? So mortgage rates, yes, have an impact, right? But 2/3 of the movement in house prices is really the imbalance in supply and demand. And so you have more people looking for housing than we have houses, right? And depending on which statistic you look at, it's anywhere between 2.5 to 4 million, right? Pick your number. So the first reason first-time buyers are struggling is there aren't enough homes to go around for everyone looking for homes. So that drives up prices, right? And we've seen that. And despite the pandemic, right, house prices continue to increase, right? And now the latest forecast is 3-4% a year. In some markets, it's 5-6% annualized house price increases. So you have, the cost of the asset keeps going up. At the same time, we have mortgage rates, which have now reverted to what I would call their long run average. If you look at the average mortgage rate over the last 40, 50 years, it's in the 5s, right? The notion that we had mortgage rates in the 2s was a short-term aberration during ZIRP, right, where the government was just putting tons of money into the system. And so we're back to long run average, which means the monthly payment and the affordability, right, is stressed, is harder. You also have historically the highest student debt ratio, right? Despite what the government is trying to do in reducing that to some extent, most first-time buyers today have student debt balances, which further depresses their available budget for housing, right? So that's the third reason. Then the fourth reason you have is that what used to be effectively a government subsidy in the sense of mortgage interest tax deduction is no longer really there for first-time buyers, right? Because a first-time buyer who buys a $400,000, maybe $300,000 home, who has $100,000, maybe $80,000 in household income, they don't itemize their taxes, so they're not getting mortgage interest tax deduction. They're taking the standard deduction. So all of those things are coming together, and we've seen it in the data where first-time buyers. But last point I forgot is you also have cash buyers, whether they're well-heeled second-time home buyers or institutional buyers, right, who are picking up starter homes. And so if you're a first-time buyer and you come in with maybe an FHA mortgage and a down payment assistance program or some money borrowed from your family, it's very, very hard to compete. And so where we're focused is exactly that problem, right, which is how do we help people who have good incomes? So think household income in the 70 plus, 70,000 plus, 80, 90, 100, 120, 140. So, not Google engineers, but also not people who can't afford housing, but, right around the area median income plus minus, call it 30%. So good incomes, good credit, right? So right now our average FICO in the portfolio credit score is 741, right? So people who have managed their credit really well, who've been responsible, but who haven't saved for the down payment. And that segment of the population is growing significantly, right? And there are people who should be able to buy homes, but haven't gotten there because they haven't saved for the down payment. And so that's the core persona or segment that we're helping. And so what Ownify is really an on-ramp to homeownership. And the way it works is we've challenged the notion of why do you need to take on debt to buy a house? Why can't you buy a house as equity? And so if you think about, a home, it's an asset that you can either buy 100% of the asset or none of it, right? You can either rent or you can buy 100% of it and then pay it off over 30 years with a mortgage. So we've challenged that notion and said, why couldn't you buy your home brick by brick? Why couldn't you buy your home in fractions? And so that's what we've structured. So the way this works is that we underwrite customers. They come to Ownify either because their agent refers them or they come directly. And we underwrite them based on credit and income. We've built a pretty sophisticated engine there. And at the end of that process, they get a budget. And it says, congratulations, Gary, your home budget is $450,000. You go out and then look for a home with your agent and submit a home that you want to purchase back to Ownify. We underwrite the home, value that, and then we make an all-cash offer on that home and buy it effectively on your behalf. Once we purchase the home, what we're doing is structurally we're creating an entity, an LLC, limited liability company, that purchases the home, and that LLC issues 10,000 shares or 10,000 bricks. Right. On day one, that $400,000 home divided by 10,000, each brick is worth $40. And what you as a customer sign up for are really structurally three agreements that work in parallel. The first one is an equity purchase plan that says, I'm going to buy roughly 13 bricks every month for the next 5 years. And the reason it's 13 is that on day one, you buy 200 bricks or 2%, that's your down payment. 13 bricks a month times 12 gets you to roughly 160, times 5 gets you to 800. So the total is 1,000 bricks over 5 years. So we're helping you build equity from 2% to 10% through this equity purchase plan. But you're buying those bricks every month at the then current market value. And so you're an investment professional and you'll get this, effectively what we're allowing the customer to do is dollar cost average the purchase of the equity in their home, right? When home prices fall, their monthly payment actually buys slightly more bricks. When home prices go up, it's slightly fewer bricks. And because home prices jump around, right, they kind of follow this march over time. Over time, that averages out. And so the customer builds equity by buying shares in the entity that holds title to the home. So that's the first part of the agreement. The second part of the agreement is a simple lease that basically allows the customer to live in the home, right? And if you think about it, the customer is fractionally, they're their own landlord. So whatever number of bricks they've built, they don't have to rent. They own that portion of the home. They own that portion of the LLC. So their rent over that 5-year horizon actually goes down.
Okay.
Right? Because they're increasing their pile of bricks, the pile of bricks that they have to rent goes down.
Okay.
And then the third agreement is a purchase option that allows the customer to buy the home from Ownify or from the LLC at any point in time. Again, at
Okay.
current market value, right?
Mm-hmm.
And we put some floor in there to make sure that the investor is protected. And so all of that effectively creates this on-ramp where we have highly qualified first-time buyers picking homes, living in the homes, building equity, paying rent along the way. And at the end of 5 years, once they have 10% equity, they can get a traditional mortgage, use that 10% as the down payment, buy out the home from the investor pool. So that's the consumer value prop, or the ONI, as we call them, value prop. On the other side
Okay.
is an investor value prop, and that's why, massive passive cash flow is interesting here, because ultimately what the investor value prop is, as an investor, you're buying and holding those bricks. So you are a fractional landlord for that ONI, for that home. And
Mm-hmm.
while you're holding the bricks, the customer is paying rent on those bricks, right?
Mm-hmm.
And so you're getting that rental income as a quarterly dividend, and you're getting the home price appreciation. Because this is equity,
Mm-hmm.
right, for the customer as well as for the investor, the appreciation is shared pro rata. So if the home appreciates by $100,000 and the investor
Mm-hmm.
pool owns 90%, 90,000 of the appreciation goes to the investor pool, 10,000 goes to the ONI, right, who lives in the home.
Okay.
So for an investor, it's an exposure to owner occupied or occupied single family real estate, where you're getting rental income and you're getting home price appreciation. Now, the reason this is interesting is that the way we underwrite and structure the program really creates this incentive alignment between the ONI and the investor. And so, for example, one of
Okay.
the things we've seen is we've had zero vacancy, right? Because we don't buy a home until the customer has identified the home. So they
Okay.
pay rent from day one, right? We've not had a
Mm-hmm.
single late payment across the history of the company because, again, 740 FICO, we're diligent in underwriting. So both of those things ultimately increase rental yield, right? And then most importantly, we've had about 60% lower than industry average maintenance cost because the owners living in the home treat them as their own, right? They
Yeah.
do repairs and maintenance, and they take care of the lawn, and they do the, empty the gutters and drain the water tank and do all those things that we need them to do,
Mm-hmm.
right? And one of the things we're working on is neat little engagements engagement, mechanisms where we say to the ONI, here's a video of how to drain your water tank. Take a video of you draining the water tank, send it to us, and we'll send you an extra 3 bricks, right? Which is $120. And so you can incent ownership behavior by virtue
Mm-hmm.
of distributing incremental equity, incremental bricks.
Okay.
So let me pause there. Does that make sense?
Yeah. So just to recap, because that's definitely a unique approach, but each individual component, each of the 3 steps, it's those are things that are already being done in different applications, but you're bringing it all together. So just a summary, and you can, I'm going to turn this back over to you, and you can kind of fill in the blanks. Initially, someone is they're in a lease agreement, so they're renting the bricks of the home, but at the same time, they're purchasing several bricks at a time. I think you said 13 bricks at a time. So over time, their ownership portion increases, and what they're renting, what they're paying for rent, actually, that portion decreases. I mean, does the rent itself decrease, or just the portion that they're renting decrease? And I'll let you tap in here in a second. And then the third piece is you have a purchase agreement. So kind of review the summary and then take us into the purchase agreement. Is that traditional, standard? I mean, kind of help us fill in the blanks a little, because I know a lot of people, you'll probably get some questions on this, but I think a lot of people right now, I'm sure their antenna just went up because they're seeing a way to home ownership they didn't see before,
Yeah. Yeah.
Yeah.
Yeah. So the first question is the rent, the actual dollar amount that you pay in rent goes down over the 5-year horizon.
Okay.
Now, interestingly, the rent yield, right? So for real estate investors out there, you'll understand this. The rental yield, meaning the fraction of rent divided by the purchase price of the brick, that stays constant. So for the investor, the rental yield doesn't go down. But if you think about it, the customer is renting 98% of the home on day one, 95% of the home by year 2 or 3, right? 90% of the home by year 5. If they want to keep going, they can go down to 80 and 75%, right? And so the dollar amount of the rental payment goes down, but the rental yield for every dollar invested by the investor stays the same, right? And that's what makes this attractive, right? So you don't have kind of yield compression on the investor side. You actually have a constant rental yield, right? And for the customer, it's attractive because one of the biggest things we've heard, and we've talked to thousands of consumers about this, right, is the big drawback in renting is twofold. One, my rent increases every year. I hate that, right? I don't have certainty. Two, I don't build equity. And so what we've done here is we've created this hybrid between a mortgage and the traditional way of owning a home and renting, where we've removed those two issues, right? To say, okay, we're going to make sure that your rent is not just fixed, it actually goes down over time, and we're helping you build equity. So Gary, you asked the question on the end, the purchase agreement itself, right? So you meant at the end of 5 years, what happens?
Yep.
So there are really 3 scenarios here, and the golden path that this product is designed to do is help the Oni buy the home. And so what we're doing over the 5 years is, one, the Oni builds equity, so they end up with 10%, which is, on a $400,000 or $500,000 home, that's a nice chunk of change.
Yeah.
2, they're making payments along the way. So and so far everyone has a great credit score, but they should be eminently credit qualified, right, at that point. And most importantly, they have effectively the right of first refusal to buy the home. So it's not a competitive situation. They can take all the time they need to get mortgage ready, right? If they want a 60-day close, that's fine, right? If they want to pull together different mortgage lenders, go shop around, that's all fine, right? Because no one else is outbidding them for the home. So that's the golden path, right? And the customer uses the 10% equity as a down payment, gets a mortgage, buys the home at the future market value or the then current value, right? Now we put a floor in there to say you cannot buy it for less than 5% above entry to make sure that the investors are protected in case there's a dip in house prices somewhere along the way. The second scenario is one where the customer says, I don't really need to buy the home. I like living in it, right? I don't want to take on this huge amount of debt in a mortgage. I'm just going to keep going with Ownify, and I'll renew for another 5 years, and maybe I'll keep going and build equity from 10 to 20%. And that's perfectly fine, right? And that's good for us. And the third scenario is one where the customer might say, I don't want to live in this home anymore. Maybe my job moved to the other side of the country. I need to move. And at that point, they can trigger a buyout, and Ownify will buy back their accumulated equity, so somewhere between 2 and 10%. However, we'll charge them a 2% relisting fee, right? Because at that point, we'll turn around and we'll put the home back onto the market. If we can find another Oni to go in with the same structure into that same home, that would be great. But most likely the scenario is we put it out on the market. And so the Oni has the ability to extract their equity minus that 2% relisting fee.
Okay. Well, it sounds like you got all the bases covered for one, but it's actually a brilliant design. It does allow people that have some degree of ownership. So even with the rent to own, the way you're doing it, they do have a degree of ownership. They have a share of equity with each rent payment that goes in. So they are building up equity. So then when they get to phase 3, when they go to do if they choose option 1, which is do the purchase traditionally, they just simply go to a lender, qualify for a new mortgage that then gives them, title to the property, complete title, and then they pay the mortgage company from that point going forward. And you start off with a 10% equity position. So the lenders like that, and you've been their creditor for 5 years, to help them build up their credit. Yeah.
You mentioned,
oh,
sorry, go ahead.
No, that's okay. Go ahead. Yeah.
Gary, you mentioned rent to own, right? My co-founder, Ben, was COO of one of the largest rent to own companies. And before that, he was head of mortgages at SoFi. So he came out of the mortgage rent to own space, and has bought 5,000 homes through his career. And so one of the things we really did when we built this program is looked at how do we take rent to own and improve on it, right? And make it rent to own 2.0. And the missing piece in rent to own offerings historically was this true equity ownership, right? Where you say
Mm-hmm.
to someone, you're not just putting money aside into a savings account to save for a down payment, you're buying equity in the home, right? And
Mm-hmm.
building that is actually that wasn't easy, right? That's not trivial. You need the legal structure, which is why we built the LLC and the share issuance. And you need the
Mm-hmm.
ability to value each home every month, right? In an automated and scalable fashion and in a way where you don't have any disputes around that. Because again, just like a share, right? You're buying equity in your home. And one month it might be worth $36 a share, and the next month it's 37, and then it might be 35, 50, right?
Mm-hmm.
And so that engine of valuing homes is the piece that the industry really hasn't had, and that's what we've built, right? And that's kind of core
Yeah.
to running that ledger on an ongoing basis.
Yeah. Well, this is far superior. The old rent to own been around for a long, long time, but I would give an analogy. That's sort of like the old horse and buggy, and what you guys are doing is like a far advanced, like a hybrid car, versus the old horse and buggy. It's just an ingenious design, and when I first saw that we could have you on, I'm thinking this is going to be awesome, and I looked into it. I didn't understand it fully, like I understand it much more now than I did before, but it is a brilliant design, and hopefully everyone listening is going to share this with their friends, neighbors, and colleagues that are or their children who are getting out of college and they're straddled with college, debt, and it's just there's so many factors involved, and this is an answer. This is a solution. And the thing I really like about it is that you did it. We didn't. Most two people are too often guilty of saying, "Boy, the government needs to do this. The government needs to do that." Well, not always. And certainly, we all need interstate roads to travel on, and we need a military. All those things, absolutely, government should be doing. But answers like this, when it comes from the population, it comes from your citizens, it's far, far better. It's usually a lot more affordable. You don't have as much overhead. I mean, I'm not knocking the government because I come from a family of, I used to work for the government. But let's face it, when you involve the government in things like this, look at all the overhead that's created, the additional overhead and expense that's created here. You're able to go directly from owner to buyer using your program, and it doesn't get any better than that. So, hey, a few more questions. I know we're going to run short on time here, but
Yeah, can I just
is
make
this
one?
available for?
Oh yeah,
Oh,
go for
yes,
it.
go ahead. I'm sorry.
No, I
Yeah.
was just going to say, that it's
Mhm.
interesting that the government obviously, eventually might have a role in this, but short term, the real focus we had here is how do we activate capital that might already be in the community, right? How do we activate investors and give
Mhm.
them a value prop that says, look, you can invest in single family homes, potentially in your own community. You can enable home ownership, right? That's an impact. That's a net positive. You're putting capital to work. So far, we've gotten
Mhm.
16% return for our investors on an annual basis, right? So that's a
Nice.
solid return in single family homes. And
Mhm.
so what we're trying to do is marry, market rate return, that impact that you're having on building stability in local communities, but doing it not with
Mhm.
government capital, right? Doing it with actual investor capital. And then obviously on the other side, solving for the consumer need. And because the consumer need is large, right, we can be diligent and selective in underwriting, and that's a win-win for both sides.
Yeah, I agree. So a couple questions. Is this available all over the U.S. or is it in certain states? And do you involve real estate agents in the process too? Can a real estate agent bring somebody to you and be part of that? If you can touch on those two things, that would be great.
Yeah.
Mhm.
So the investment opportunity is available to accredited investors anywhere in the US, right?
Okay.
There's the Ownify Home Fund that individuals can invest in. That's a 506c fund. So that's open to anyone who's accredited
Hmm.
to participate in the wealth creation from an investor perspective. As an
Hmm.
ONI, we are live in North Carolina today.
Hmm.
We're looking at the next couple of states: South Carolina, Tennessee, Florida, California. Um, that is to some extent dependent on where investor capital is interested in
Hmm.
taking us as well, right? And so we're looking at individual markets. Largely, they're metro markets,
Okay.
and we have a list that we want to work down. But right now, it's North Carolina on the
Okay.
ONI side. Now, to your second question, Realtors. We love working with realtors. So we have realtors who've invested in the fund because realtors love real estate. They love passive income. They understand home price appreciation, and they understand the model. We also work with realtors directly in helping first-time buyers. And so there is an accreditation program on our website. If you're a realtor and you're listening and you want to get involved with Ownify, come check that out at ownify.com. Generally, every customer that comes in gets partnered with a realtor, right? Because we need someone to hold their hand in visiting homes and selecting the right home, making the purchase offer and all that. And then we work very closely with those agents. And one of the interesting value props for agents that we work with is you get full commission on the purchase, right? When we purchase a home on behalf of your customer, on behalf of the Oni. And that agent who brings the customer or the home to us and closes the deal also gets the listing if that customer doesn't buy it from the fund, in the next 5 years. So if we have to put it out back onto the market, we go back to that agent. So there's a dual value prop to the realtor.
That's awesome. Well, we can definitely help you with that because we run a team of real estate agents. It's unique. It's not a brokerage. We're inside a brokerage, but it's a true production team, legally, contractually, in every way. But we're in 38 states. So I think I'm going to invite you to teach one of our Monday Night Live classes. We'll talk about that off the show, but
I'd love to,
that'll help you get going because I love the product. I love what you're doing. It's absolutely solves a need right now. And boy, we need solutions. We need creative thinkers and innovators, and you definitely fit the bill. So for everybody listening, I hope you just got your interest piqued, especially if you're a real estate agent and or an investor, which is that's our audience. And we work with investors and agents both and bring them together. So in any case, any final words of wisdom? I know we're kind of running along here, but this has been such a great podcast. I don't, maybe we'll do another one, but Frank, how do we get a hold of you? How do people find you? You mentioned the website, Ownify.com. You could touch on contact information. That would be great too.
Yeah, of course. No, thanks for the plug. Come to Ownify.com, OWNIFY, right? Ownify, we make owners. That's the whole idea here. You can reach me at frank@ownify.com or 415-549-1939 is my direct number. Yeah, if you're an investor interested, I'd love to talk to you. If you're a realtor or real estate agent, right, in any market in the US, obviously one of the things we've done in every market we've launched, we've connected with local realtors to help build the network, build the brand. So if you're interested in working with us on that, that'd be fantastic. And if you're an Oni, right, and you're looking to buy a home, please reach out. And lastly, this might be the other interesting one. If you're a landlord and you have a customer who could be a buyer, and you've always wondered, how do I put that person onto the path to ownership? We're working with a couple of folks on that structure as well. And say, you can use our program, right, to take your existing home with your existing tenant and ownify them and turn them into a buyer, over some period of time as well. So lots of opportunity here. It's just a different way of thinking about real estate, right? And I think it opens up a lot of avenues for folks.
Yeah. Well, it's very creative. And it also, once people hear it, and sometimes you have to hear something once or twice or three times, but it makes so much sense and it's easy to understand once you grasp it, the concept. So listen, I really appreciate this again, Frank. I'm going to hang on before, I'm going to have a question for you when we're done, but for all the listeners, please leave a review for this. We love your reviews. It's the currency of podcasts. It's what makes the podcast world go around. Your reviews are more important than you can ever possibly know, because we don't actually get paid for this. I mean, indirectly through business, yeah, that's true, but directly, it's a community service. We do it because we enjoy it, and it's great to inform and entertain, all of our followers. So if you don't mind, leave a review. We really appreciate that. We will see you on the next Massive Passive Cash Flow podcast. And for you listeners and for Frank, God bless you and your families, and have an awesome weekend.
Thanks for listening to this episode of Massive Passive Cash Flow. Be sure to go to realestatewithgarywilson.com to join our community and start building wealth today.